I'm sure you've heard more than enough from me, and so therefore I asked Mitch Bergeson, who is the head of the financial services practice at Landor in New York, to come and facilitate this discussion. Mitch is an engineer with an MBA in marketing and strategy who has the distinction of working for Stern Stewart for 11 years in South Africa, Europe, and latterly America before joining Landor in 2005. And as I said, he specializes in financial services. So I'm sure we'll have a few interesting perspectives to grill the panel. Thanks.
I'm going to take a moment just to recap briefly. It feels like the day has been a tale of two halves. I think those of you who've been here all day might agree that this morning we took a look at the conventional banking sector, and I think there was a general consensus that there is no lack of competition. I think some of the speakers this afternoon said this, but there is a lack of choice in the conventional banking sector. By contrast, I think this afternoon, David constructed the agenda consciously this way, we were led into interesting discussions about innovation and alternatives. And I think definitely the opportunity to push the boundaries. Now, the central question that I think we've been confronting, talking about apples and lemons, talking about type 1 and type 2 responses to stimuli. And every one of the speakers in some respects has looked at this divide, and I think that the burning question that I'd like to put to our panelists is, are these two sides destined forever to be separate, in that you're going to have this conventional, regulated, established industry doing just enough to offer satisfactory goods and services to their customers and competing in a defined way, and then innovators on the fringes offering the types of innovations you've all talked about, winning awards and so on, and building strong franchises with very narrowly defined customer bases. Could each of you talk a little bit, in fact, Marion, you used the word convergence. You held up your smartphone. Obviously, that's a device that is a point of convergence, but maybe we could start with you to talk about how this may come together and the conventional players that may have permission to innovate eventually do, and embrace some of the great things that we've heard about this afternoon.
So I was sort of in the privileged position, I guess, of working with both sides of the industry. And so working with the traditional banks, clearly on a 40-year relationship that's changed many times over that period, but also partnering on working with the innovators, because innovators are faster to market, take more risk, et cetera, et cetera. And so in a privileged position to try and bring those together where appropriate. That being said, I see a distinct appetite in the traditional banking market for differentiation. And a lot of that's been driven, and I think, Mark, you said sort of thank God for the regulator, because it makes us react, it makes us do things. And, you know, the regulatory pressure to be more competitive, to open up access to traditional banking and traditional banking products and to compete has helped to drive that. So I think that the innovators play a key role. I think we need facilitators to bring them together in meaningful ways. But I also see traditional banking taking more steps to look at product differentiation. And I have a number of examples that we're working on to see how we can do that. But to your point, I think it will take time. You know, it takes time to change risk appetite. It takes time to invest in the right areas. But I think they should work together more closely. Traditional banks have the reach, they have the customer relationships. People are shifting, but it's slow. And I think both should work more closely together.
Great. Jamie?
So I guess I look at this from a slightly different angle, not working in the banking sector and knowing very little about it, to be fair. The thing that strikes me listening to some of the speakers this afternoon is that banking draws many parallels with the media sector. I think if you wind the clock back to 10 years or so, there were 3 media providers in the TV sector. There are now hundreds of channels. There are a number of ways you can reach your consumer and your marketer, and your market. The level of innovation is only increasing, and I can only believe that's going to happen in the financial services and banking sector, not least because the route to market for you to your consumers has exploded. So whether it be through digital channels, through social channels, through TV channels, the opportunity to have a direct conversation with a consumer is out there now, which means that brands like Zopa can launch without any marketing spend. Who'd have thought that 10 years ago, or indeed probably 5 years ago? So understanding who your consumer is and having a direct conversation, a direct relationship, is a real opportunity, and it will threaten the big four, the big five that we've heard talk about today, in my view.
Great. Mark.
Revolutions in banking take an awfully long time. They're quiet, which explains the only reason you can explain why we still got checkbooks kicking around. And I would suggest that at some level it explains why you still got branches kicking around. So we're a business that didn't have branches, and we've never had branches, but that's not the same as saying our customers don't use them. They use HSBC branches, obviously, but they also use other branches, and they use everyone's ATMs. And you can test your brand loyalty when you're standing in a queue in the rain waiting for an ATM. And really your choice of ATM will be driven by the longest queue, not necessarily by the brand you bank with. And so what it demonstrates is that you don't necessarily need a branch network or an ATM network that carries your brand in order to be a successful bank or to deliver superior customer service. And I genuinely believe that. But I also think it's important that technology obviates the need for physical presence, because it allows you to have a conversation face-to-face now through video over IP with an individual. And I think that still has validity. I genuinely do. I think it's the difference between a GP and a consultant surgeon. There are times when the GP's fine. You don't need to see them because it's a fairly straightforward transactional relationship that you can afford to have. But there are other times where you're going to want to speak to somebody and see somebody. And whereas once upon a time you had to get in a car and go and do it, or they'd have to come to you, I just don't believe that's necessary technologically anymore. And consequently, I'm not optimistic about the future of branch banking in the UK. But that's not to say that it's a massively urgent thing to suddenly turn up on Monday morning, close a whole bunch of branches. I don't believe in that. I think you've still got customers that you've got to persuade to come with you to the model that you believe will win in the end. Because if you're not willing to persuade your customers, then one, it seems to be horribly disloyal, and two, I think they'll gladly walk to somebody else who will.
Giles.
I was struck. I think it was last year. I read a report. I can't remember which one it was, but one of the big accounting firms, Deloitte or Ernst & Young or PwC, wrote a report on the industry, and was talking about their recommendations for the strategy that banks should follow, and commenting on what the banks, talking now really about the big five banks, what they were actually doing, and they were all doing the same thing. So they were all in pursuit of the mass affluent customer. There didn't seem to be any differentiation in the strategy at all. And to me, that's the important point. It's not the technology, it's not the route to market, it's about actually what the strategy of the business is. And as long as banks continue to exhibit extraordinarily convergent strategies, then I think it provides enormous opportunities for disruptive innovators like us. And I think it's more about that, ironically, than it is about the routes to market or the technology.
Well, thank you.
But I think it is about convergence. And to your point, Mark, about branches, but look at Metro Bank, whose whole premise on launching...
They're probably the most differentiated.
Yeah, most differentiated, but their whole premise is on the branch network. It's how many branches they've got, spreading out, latest one, Milton Keynes, spreading out from London. It's about the branch, it's about the physical place, it's about open on a Sunday, open late on a Saturday. You can walk in off the street and talk to a person. So I think it's convergence, it's about having both, and it's about the particular business finding the model that works for them and their customers. So physical as well as digital, be it a branch, be it technology, be it a payment. And if we remember the cheque debacle where the Payments Council said, let's kill the cheque, and of course the lashback from the consumer was huge because they're just not ready. So it is about timing, and it is about having both, depending on your business model.
Mm-hmm. You talked about defining what matters in the value chain and segmentation of needs and different customer types. Maybe talk a little more about if there is room for different business models to service these different constituents. What are the sort of threshold things? Every bank is going to have a mobile payments infrastructure. I think those that don't right now are significantly endangered. But what's the role of this type of innovation in raising the bar for those types of givens that every bank needs to have? Sure, yeah, go ahead.
Well, I sort of wonder why there isn't a low-cost model of banking. I'm sure if anyone does it well, it will be extraordinarily successful. I wonder. I mean, I think Mark's business is probably closer to our business than it is to his parent in many ways in terms of philosophy.
You might say that I couldn't possibly comment.
So, I mean, I think you're right in saying that there are certain things that everyone must have. But I'm not sure that's how. I don't think any of the big five banks is going to differentiate itself by having a better mobile app. Would be my assertion.
It was all incremental, and that's the difficulty I have in this industry is that we never make a decision, which is understandable. And so every time we do something, it's incremental, and therefore you get an explosion, an almost exponential increase in transactions, and then you get transaction shifts. But now you've got multiple platforms that you're maintaining in sync, and that is adding to the cost layer of your business because you're serving customers aged from, most banks are serving customers aged from about 11 to 100. That's a very, very expensive business model to be good at in every part of the proposition. I think if you try to do that, it's logically, ultimately, that because of the incremental cost of adding things but taking, frankly, nothing away, you end up with quite an expensive thing to manage. And arguably a risky thing to kind of keep stable.
Mm-hmm. And every FMCG company in the world would target different groups of people and accept that people come in different lifestyles, different stages, and serves particular groups incredibly well. I mean, computers are amongst the most commoditized products on the planet, but we all aspire to owning a silver thing with an apple on it.
Is there a danger that as, for example, your business grows, and the regulators take notice that you have to then fall into the more conventional parameters of the banking sector. To use the language of technology as we have today, that you then get kind of subsumed into the rules of the operating system as opposed to being an app, something cool, something that connects. And then, just the uniformity, the standardization process just continues.
So we are being regulated from the 1st of April, which is something we've been calling for about 6 or 7 years. And I'm sort of, so far, very positive about it. So ask me again in a year. I think there were some really important points we had to get across to the regulator and to their masters at the Treasury, which was where the risks in the business lay, and for us not to be regulated for doing things that we don't do. So we wanted to make it very clear we run a marketplace. We don't therefore we don't use a balance sheet. Therefore, we shouldn't have to have balance sheet reserves. We'll find out in 2 weeks' time when we get the definitive Bible as to what regulations we have to follow. But it seems that our main issues were all agreed. Now that's not to say that there won't be scope for. I mean, sort of generally speaking, regulation only goes one way. I think that's what people who've been regulated for a long time will say. It seldom becomes lighter. So I think it then becomes incumbent upon the industry to behave responsibly and sensibly, such that the regulation that we start with remains. But no, clearly it's a risk. But I think it's very important to understand we aren't a bank, so we'd have a pretty good argument for saying don't regulate us like a bank because we don't do banking, because we don't manage treasury risk, which ultimately is what banks do.
Okay.
Questions for the panel, actually, but I'd start with what you were insisting and stressing on, Giles, which is creation of value. And the sort of lingering question I would have is, as we get on the mobile phone, the relationship, the channels of relationship, the nature of relationship between people and their bank changes, is their perception or reality of value from banking going to change, and therefore making the bed to the innovators compared to the traditional banking? And how do you see this? How do you anticipate this? And what is the nature, frankly, of that change?
But I'll start quickly. Value isn't just about low cost. So if banks can provide experiences that delight customers, they'll pay for them. That would be my assertion. So in the absence of that, in the absence of great service, then cost becomes incredibly important. But if people can use technology to deliver better services and delight people, Mark isn't always the cheapest. Yet he
Thanks
went.
for that.
But you know, the people are prepared to pay for that delight.
And I think
Dave?
what won't change and up for debate is that people's salaries and wages go into a bank account. You know, so that's why people have a bank account. It's the destination point of their income. And whether it's a PayPal or whether it's an innovation on the payment side, there's still a transaction from and to the bank. So even if you're using a mobile phone and you bought that phone with the payments capability from a mobile network operator, you've got a relationship with them. You've also got your relationship with your bank, with your financial services, and then your app provider, etc. So I think it's important that a consumer will have multiple relationships or multiple connections when they transact, whether they use their phone, whether they use an app, whether they're accessing their bank. And that's why, you know, I don't like the sort of who owns the customer relationship point. I think, you know, a consumer will choose and have many relationships, but I don't think either of those detract from each other. You know, people are intelligent enough to know what they're getting from where, so it's important that all of those relationships play a part.
You've got an aggregating phenomenon already today. A huge aggregating phenomenon for the most financially engaged and most financially literate. So we know that customers are using aggregators to price compare before they go and make a purchase. That doesn't mean to say that they're going to necessarily, you know, switching is not just current account switching. And we didn't talk about that really today at all, which is people move their banking relationship piecemeal. They don't necessarily do it nice and cleanly to say, I've moved it all from A to B. And I think, you know, we're into the ISA season, for want of a better label, very soon in the UK, and there'll be a huge churn of deposits in the UK banking industry, but it will not necessarily be accompanied by current account switching unless banks try to impose that as a condition. And I think that's the new reality. The question becomes one of, are you prepared to tell the customer what better value they could get elsewhere all the time without them having to go and look? And disaggregate the aggregators. And at the moment, the industry is not prepared to do that. So the customer's actually got to go and make the effort and go and have a look. And I think that's, you know, there's a debate to be had about whether that's a workable model or not. But if you're not afraid that customers are going to leave you on the basis of price, then you wouldn't be afraid to tell them how much more they could earn somewhere else. If you truly believe that you're not delivering a commoditized proposition, then, you know, and if it's only money, then I think that you'd be prepared to show them everything.
David.
We've talked today once or twice about different industries where there's been a change, radical change in the level of competition. So low-cost airlines 10 years ago, whenever it was, radically changed the airline business. The energy business changed when they removed regional monopolies. If we look at the supermarkets, they generally have been exceptionally competitive, and someone was saying earlier on they've been very competitive. I think it's quite interesting that if you read the papers last week, the active investors in the States are now saying they're fat and bloated and lazy, and you know that's amazing, talking about people like Tesco. And there are these active investors that are buying into the big four to put the screws on them, to sell their estate into a property company and lease them back, to get on the bandwagon of price cutting and to innovate more. So not only, in my opinion, are they already doing a pretty good job of driving all that, they've now got people on their back telling them to do more. And we've heard this afternoon some very interesting things about innovation and new service. Well, actually, First Direct is quite an old service, but you know it's in amongst the challenges, I suppose. The big question is, well, the industry is still fairly complacent and unchanging, really, in a way, if you look at it. The bulk of the banks haven't really changed. Is there going to be some kind of big shift sometime in the next 5 or 10 years? And that's what we've sort of skirted around. And is it going to be caused by technology or customers or what? Or are we going to be here 10 years from now and we'll be saying exactly the same stuff?
I don't know when it was, but a few months ago I was reminded that free banking was introduced by Midland, I think, famously introduced by Midland, right? and it was the clarion call or the sort of ring bell of disaster. The introduction of free banking, giving away a expensive service. I think my response was, and where was it written that everyone else had to do what Midland did? Because it wasn't actually a given, but the industry decided that, in fairness, that was a massively challenging model, and it had to respond, and it responded by pretty much price matching or proposition matching Midland at the time, because as it looked at things, it couldn't see another way. It couldn't see another way out. No, I wasn't in the industry at the time, but I've read about it. Yeah, and it's held up as it was a disastrous thing for Midland to do, because it transformed the relationship and therefore led indirectly to a whole bunch of charging mechanisms that are cross-subsidizing and not transparent, because you didn't actually say that the banking itself costs money and therefore you have an obligation to say what it is. But what I see from it is that the ability of the industry to respond to real and present dangers, even within the industry, is formidable. Yeah. So do I think it's going to transform almost spontaneously from within? Really, no, not at all. I think it'll be different if an incumbent, and I'm talking about a major player, decides enough that it's going to be different. And I think that's an act of faith. So I refer to what I said in my presentation. How else can you explain, for 25 years, a static level of customer satisfaction in this industry? It can only tell you that customer satisfaction is not important enough for the banking industry to do something about it. Surely it's not coincidental. So unless you've got, and I don't see anyone on the horizon who's going to be big enough to make a big enough difference short term in this industry, it has to come from an incumbent. And it's not about price, although, let's be honest, the last big structural change, I'm talking about free banking, had that effect. It had a massive effect on the industry. Not necessarily positive in the end, but profound nonetheless.
So is that, no, it won't change?
I don't see it, personally.
I would agree. I think in 10 years' time it will be different, and there'll be different services, but not hugely differentiated. And I think the difference between that and the, say, travel and, with low-cost flying is what low-cost flying has opened up the market to many, many more that had never travelled or didn't travel. That's not the same in the UK with banking. It is in some countries where there's significant unbanked populations. I was in Mexico recently and they have 80% unbanked. We have about 4% unbanked. So, it's not as if we've got this massive market that we've now got we need to service in a different way. And I think it's also interesting that even with the, switching guarantee to make it easier for you to change your bank, still people don't change in floods. It may be they take out a travel product with an organisation, or a personal loan with a different organisation, or a credit card with a different organisation, but wholesale shift. People's emotional attachment to their banking relationship is far deeper than booking an air ticket. And it was interesting, I was in Dublin last week, and last Saturday was Change Your Bank Saturday. It's a big marketing campaign with all sorts of banners in the street. It's Change Your Bank Saturday. Now, I don't know what the result of Change Your Bank Saturday was, and it was pouring with rain, so it probably wasn't very high. And bearing in mind the banking crisis in Ireland is more profound, than because it's smaller and there are fewer incumbents. It's the big two, not the big five. But I just think the market dynamics are very different from banking than they are from travel and they are from supermarkets.
Yeah. I think if it happens, and I'm not asserting it definitely will, but I think if it happens, it will be driven by the next generation, people who don't currently have a bank account, who simply say, I can do without. And I think your assertion that people have this relationship because their salaries get paid into a bank, if that gets broken, if there's a generation of 17, 18-year-olds who say, you know what, I'll concoct my own solution using my mobile phone company, my phone, and a prepaid debit card, and an ecosystem could evolve that doesn't require banks. I think that could be incredibly powerful. And I suspect it won't be driven by a clever businessman. I think it'll be driven by happenstance and people figuring out that it's not a relationship that they think they need. And if you don't think you need a relationship, you work quite hard at avoiding it.
Is that not though, because there is little or no point of difference between the banks in the public perception, there is little or no comfort in the public perception about the service that the banks provide. So a banking service feels like a utility, so you might as well be an electricity company, a water company, or a bank. It's just as utilitarian. So until someone comes up with a proposition that they can align themselves behind, that consumers can buy into, and that they can build brand trust and brand awareness around, why should people move?
We're talking about branding. The large banks are, I would say, an umbrella brand with many other brands underneath it. It's not a single utility. A lemon is not a brand, it's a commodity. You don't buy a particular type of lemon, you buy lemons. But banking is different. You have many different products in banks. You have current accounts, you have payments, you have credit cards, you have all sorts of things. My view from listening to what we heard today is the challengers are not offering universal banking usually. They're cherry picking. Southwest Airlines, which is 30 years ago, actually wasn't competing against airlines. It was competing against cars and trains. And it shook up the airline industry by accident, almost, if you like. What I think is probably likely to happen is challengers will come in and cherry pick areas, and that will have a big impact on the big banks, because if you lose some of your profitable products, and that's where you attack first, that might cause the shake-up, because you've then got a diminution in your returns, and therefore you've still got your big infrastructure, so that might galvanise someone to make some changes. I mean, the challenger banks are coming in and looking at certain areas. They're not sort of going for the asset management or corporate lending all at the same time. You're picking a small area. MasterCard is a small area. I think it's when the challengers get, so there's a lot of the products being taken, you're probably going to get the change then.
I think there's some interesting kind of realities also that we have to just be slightly mindful of. We've got probably in HSBC 1,200 branches in the UK, 1,500 in Mexico. We could probably survive off 250 in the UK. How popular would that be? You know, there is some aspects of change that are sort of a bit of a moral maze for a bank. You know, we're already bastards. So actually, let's go the full hog and have, you know, because Marks and Spencer's, I think they've got 250 stores in the UK. They're ubiquitous. We've got 1,300, 1,200 branches, I think, maybe slightly less than that these days. It's very difficult. When, you know, Antonio this morning said, I put a bunch of them up for sale, no one wanted them. So to some extent, what is competitive? You talk about the next generation coming through. I know my colleague sitting next to me who's from HSBC, and I've got kids in teenage years. You try and get a teenager some of the kind of establishment things they need to get going in life, like car insurance. No one will touch them. There are risks associated with these lovely kids who might have a Zopa loan or whatever, but it's kind of difficult. And so we love these things to be nice and simple and binary. It's no branches and all online. Or it's the kids will rewrite the rules. No, they won't. And we have to find a reality to the changes that are needed in our business. I do think putting the customer at the centre, which is what we've all heard today, loud and clear, and everyone's talked about that, is very important. But we love things to be very binary, particularly bankers. They like all things to be either all black or all white. And we've got to understand that, you know, in a period of time when I suppose I was growing up, you know, you used to watch Tomorrow's World that used to tell me by this stage in my life I'd have a silver suit, take pills, not eat food anymore, and ride around on the Jetsons scooter. Well, of course, none of that stuff comes true. And actually what we are today is a sort of society of animals who have, to the point I made earlier, you know, irrational kind of ways of making decisions about things, who don't want to know I can't go and knock on someone's door to get my money because that makes me feel better that there's a door and there's a human being on the other side and they've got cash. Because that's sort of some of the stuff that makes us feel comfortable. Mm-hmm. But I do salute the kind of innovators like Zopa. I think you do great things. I think it's very interesting what you do. And I love Mark's business. I'm a customer. And I think it is beholden on us to watch for those things and try and change some of the organisations if we're in the big banks from within. But I do think there is we want things to be simple. They're not going to be simple. We've made a society that is incredibly complicated. Mm-hmm. Incredibly complicated for young people to navigate, incredibly complicated for most of us to remember, you know, what our password is for the 75 different bloody accounts we've got online. We've made the world more complicated, and I think that is part of its issue.
Mm-hmm. And I have a question to ask. We hear about brands and branding, and we're talking about creating competitive advantage for the banking sector. What about alliances, brand alliances, where you look outside your area to try and make an alliance? And I know MasterCard or Visa as an alliance within the banking industry. But there are many other industries where, telecoms for example, where there are alliances and people understand the benefits of alliances, whether in fact there is any benefit of going down that track, of trying to find other brands that have strong associations which you can bring the two together to provide something which is more competitive, more useful.
I mean, absolutely. And there was a couple of examples I referred to earlier. So, you know, bringing a telco brand together with a banking brand, together with, you know, I mean, the payment facilitation is really in the background, you know, and it's about bringing those brands together to create trust, to create impact, to create reach. And dare I say, I think there's also an opportunity in the sort of force for good that I mentioned earlier in terms of brand enhancement for competing brands, you know, to build alliances as well. So if you take a Visa and a MasterCard now, I assume there's no one from Visa in the room, but they might not agree with me, but, you know, with the global reach and the number of transactions and the market share, etc., if they were to join or bring brands together for a particular purpose or for a particular opportunity, I think it could be really powerful. But I think, you know, and I spoke to some people in the break about partnership, alliances, etc. We all say, oh, you know, joint ventures never work, they always fail, and there are lots of statistics to show that. But bringing brands together in a smart way is really powerful. And somebody also asked, I think you asked me about, you know, B2B2C and above-the-line advertising. MasterCard does no above-the-line advertising in the UK. We do sponsorship, and we do priceless, which is some experience for cardholders, but no television advertising, no side of taxi advertising, etc. And the reason we do sponsorship is that brand alliance. So we would sponsor the Brit Awards or the Justin Timberlake concert because they have a brand, and that brand connects with youth. It connects with music. People download music. To download music, they go online and they make a payment. So again, that's about brand association. It's not about corporate entertaining. It's about brand association. So I'm a great believer in it.
I think it's fascinating. I think we've just got to get a bit real, that partnerships tend to be of businesses that are in some way similar. It's very hard as a startup to sort of go and sell yourself to a big consumer goods company that everyone's heard of and say we should be your financial services arm. But those opportunities open up as we achieve some scale, and our opportunities to sponsor things and things like that and push our brand that way open up because we've now got some money. So very much, you know, a very key part of the next stage of our development will be the alliances we pick, and we will pick some. And they will be game-changing.
Get good first.
Agree.
Yeah, I think you've got to be good at what you do before you should partner with, presume, frankly, to partner with anyone else. Because, you know, you run the risk, not necessarily, I mean, you know, you do potentially run the risk of saying, well, we're obscuring the fact that we're not really doing what you want us to do as well as you really want us to do it. Get good first. And in fairness, I think that also gives you a better conversation to have with a better class of brand.
So we've had low base rates for quite a while. So in the future, maybe we see this, you know, what happens if it's 6%, 7% base rates? Do you think it would change the complexion of competitiveness and the market generally?
That'd be sensationally good news. It wouldn't be good news if it caused massive consumer detriment because no one paid their mortgages. That wouldn't be good news for anyone in this room. But apart from that, bank spreads widen when interest rates go up. So bank spreads are considerably wider than they were pre-crisis because of the world is not awash with cheap money and because they're not selling PPI anymore. So bank spreads have widened, but they will widen further if base rates go up. That's been the case. I think if you look at charts for the last 100 years, bank spreads always widen at higher interest rates. So as far as we're concerned, that's terrifically good news.
It's concerning though for customers. I mean, you know, 4.8% is what you're offering, and that's not the cheapest personal loan, unsecured personal loan rate in the market at the moment.
That was in October. It was then. Yeah.
So today I think we're at 45.
45, 46. Yeah.
And mortgages, I think you're down at basically about 160, 170 bips or something for, and You know, I said it. I think it is concerning. So of course there's stress testing and there's affordability checks, and they are mandated from the regulator. But you do have a cohort of customers who haven't experienced 7, 8, 9, 10, 15%, heaven forbid, as I have, as many of you have, base rates. And that does rather change the complexion, because what you've had is an insulating effect. You know, so although you say cheap money, when has money ever been more expensive for consumers in the UK? I don't think it has it? I mean, the availability of money is a different issue. But if you can afford to borrow it, or if the industry will lend it to you, I think it's pretty good value to be borrowing money off a bank today. So yeah, that will of course change the complexion. But here's a thought. It plays to the strengths of banks that maintain very strong balance sheets. And in that regard, you know, I'm very happy, in fact delighted, that First Direct's part of HSBC Group. You know, it's core banking. It's a long-standing virtue that nobody notices until it's gone. And we had a debate earlier about bank fails, bank bailouts, etc., etc. Well, that's the consequence of not maintaining a strong balance sheet. Let's be absolutely honest.
Okay. David's going to have the last word, last question.
Okay. Well, my last question actually is for Jamie.
It's not about base rates, is it?
Possibly. Having heard all that debate about that you basically need quite a lot of guts and willingness to take risks to get into banking, and the whole issue about partnerships. So Sky has never been particularly averse to taking huge risks. And for most people, it would be an extremely attractive partner. So has Sky ever thought about getting into partnership with banks to make the difference?
I was just thinking actually about some of the roadmap innovation that we're sort of thinking about over coming years. And you know, Sky has evolved from being, you know, a satellite broadcaster, platform owner, to a utility company now, and it's part of you know, our customers' everyday lives. And it's not that far away when you can imagine a world where, if through the broadcast stream you can tap on your mobile to purchase off your Sky bill. That's absolutely not that far away. It's not that far away when you can tap on your iPad, on your Sky Plus app or anything like that to find out more information. So we're already looking at how we can extend our proposition into other utility areas, whether that's in partnership with banking, whether that's in competition with banking. We're pretty open-minded. Our goal is to be at the heart of the connected home, offering a service that allows that enriches, if you like, and makes the customer's life that little bit easier and that little bit more functional. So we're open to all sorts of partnerships, but actually the level of innovation that's coming out of Sky, in particular, slightly biased, but also across the piece, means that there are going to be any number of competitors and opportunities.
Great. Well, thank you to our panelists, and thank you to all of you for great questions. Very good session. Thank you.